I'm joined now by David Olujinmi, Senior Analyst, SBM Intelligence, to review some of our top stories in detail. Morning and welcome to the show, David.
Great
to have you.
Me. Yeah.
So, of course, we've been seeing markets yo-yo pretty much since the start of the year. So what is your reading of where we are now?
With the war in Iran, there's one thing that we know that is sure is that when there's a strike, either party strikes, either Iran strikes or US strike, there is going to be a movement. And one thing I observed, especially I went to the NUPRC's website, discovered that, like you said, it's a yo-yo. It's a very weird pattern. So we see oil move from 80 to 85 to 80 back to 86. Now it's back to 80. Then it went up to 80, 86 again. It goes up by very high percentages. In previous times, you probably see oil stay stable at maybe stay at 90, at a band. But now it's no longer staying at the band. It shows that it is a lot that is hanging on strikes. And for this week, we've seen something that I would describe as an unofficial ceasefire. Okay. Only Iran struck, and most of the missiles, according to the US, say were intercepted. But for the US, it's obvious that one thing that is obvious with this whole oil fiasco is that for the meantime, at least till November, we'll probably not see so much movement in oil prices. Oil prices will stay between the $75 to $85 band because one country that people are not really paying attention to, but should be paid attention to, is Israel. Israel has every motive, especially the current Israel leadership, have every motive to want to strike Iran. But there's something called mutually assured destruction. Mutually assured destruction has ensured that Israel is looking at, what is the cost? What is the cost? And the cost is not just on the people, it has a political cost.
Okay. So I think in terms of geopolitical expectation, the point is the oil prices themselves, because we haven't seen the highs we saw before, which is over 100 barrels, does that mean markets have essentially priced in already any major conflagration in this conflict beyond the usual skirmishes that we're seeing?
I fully agree that the market has totally priced in. Another thing is that countries who are huge demanders of oil, huge buyers of oil, the US, China, they've sort of created a system to deal with movements like this. So, for example, for all of the happenings in between March to April up until June, there was this fear that oil prices were going to go up to $200 per barrel. Some people went up to $700 per barrel. It was a tale of woe. But one thing that most people did not pay attention to was the fact that China sort of cut their oil demand by 5 million barrels a day. So it sort of affected the market, and all of that has played into what is going on right now. The market has priced in all of that risk.
Has adjusted essentially to the prevailing geopolitical risk environment. Very interesting analysis. Let's move over to a story I'm very excited about for many, many reasons. It's S&P acquiring the majority stake in a homegrown domestic Nigerian company, Augusto & Co., which many of us, if you work in financial services or in capital markets, you know the story of Augusto & Co. What is the significance of this particular transaction?
Number one big significance I'm looking at is the playing of foreign institutional capital in Nigeria's domestic debt market, in the sense of right now we don't really see so much of foreign institutional capital coming into our commercial paper market, coming into our commercial corporate bond market, and that is the market where Augusto & Co, DataPro, all of our domestic ratings agency really are targeting. We see our local pension funds, our local capital companies, United Capital & Co. You see all of them playing in that space, but we don't really see so much foreign capital coming into that space. But with the interest of S&P in a company like Augusto, in a domestic financing company in Nigeria, we will see that will change. I believe that it should have enough impact to tilt the market. Okay. In the sense that we start to see some institutional investors start to sort of track what is going on in our domestic debt market.
That's interesting. The other angle here, which I think should not be missed, is the fact that many of the foreign credit ratings agency had been subject to criticism because of some of their ratings. Do you think this kind of puts an end to that criticism? Because now they're acquiring a domestic player who used to be in a sense, competition, but from a local perspective.
So the thing with the criticism of foreign credit rating agencies is that the fact that the ratings have usually helped in sort of, I don't want to say ostracizing African sovereigns from the international markets.
Yes.
So sort of, you see the premiums on African bonds become extreme. Goes up to 7, 8, 9, 10% on dollar denominated bonds.
Yeah.
So will it take away that criticism? I really cannot see.
I mean, it's one transaction of many.
Yes.
Whether it actually alters the landscape, because the Africa was talking about creating a Pan-African credit ratings agency. So it's interesting to see this type of M&A transaction in the ratings agency market.
It's also a credit to the team at Augusta &
Of
Co.
course.
From 1992 till date, entering a market that was majorly non-existent in Nigeria at the time, and building it what it has become, to the point of getting acquired.
Indeed. Yeah. And it's a shame that the original founder, the late Bode Augusto, is not around to witness such a monumental transaction. Yeah. May he still continue to rest in peace. He was one of the bastions of domestic capital markets. Anyway, consumer credit in Nigeria fell.
By 20%.
By 20%. What is that telling us?
So,
is it high interest rates, or?
Not really high interest rates. It's telling the story of how banks are trying to cut their losses. Yeah.
Okay.
So we see a situation where our non-performing loans, the ratio is increasing. The ratio went almost as high as 9% in 2025.
Right.
So we've seen that situation now play out into how they are going to, and I'm projecting that it's going to fall even more in 2026. Because a lot of banks, and we also see that situation with the forbearance exposures, forbearance regulations that the CBN put out in 2025, how it's also playing out. Basically, it's a situation that tells the story of Nigerian banks are trying to cut their losses, trying to look out for the sectors where they are prone to having non-performing loans. It also tells the story of the credit system in Nigeria, and there's still a lot of work to be done when it comes to having people pay back their loans. Yeah. Another thing there is that consumer credit is a significant driver of the local economy. Yeah. Right. Personal and retail loans actually are a significant driver.
Retail loans are still very robust and resilient according to this data.
Yes.
Yeah.
So those are they are a very big driver of the economy, and I think that when we have situations like this, it's a call for concern such that we've seen private sector credit drop. We've seen it drop a lot this year. So I think the CBN should come into play now and say, okay, we need to do something to support the fiscal side as well as we're doing our monetary side of things.
Yeah, fantastic. Let's look at the Ghana story, which is the government setting up this Ghana Gold Board to essentially buy gold reserves, replacing what the Central Bank of Ghana used to do before. So what is the strategy here? So
the Ghana Gold Board was set up in 2024. Immediately, Mahama became president. But the thing with the Ghana Gold Board is that in 2025, the Central Bank of Ghana posted a loss of about $3.1 billion recorded off of buying gold from artisanal miners. They have a policy where Ghana's central bank directly buys the gold. But now, because of what happened in 2025, and the bulk of that loss was down to buying gold from the Ghana Central Bank. So they are trying to shift that responsibility away from the monetary side, shift it to the fiscal side. Okay, if we're going to buy gold from artisanal miners, one of it is that one of the major aim of that policy is supporting the local mining economy, because it's just for artisanal miners, it's small and artisanal miners. So one of the aim of that policy is, okay, support the local mining economy, but however, it's also to drive up, shore up the Ghanaian reserves. Gold was one of the big factors that really sustained the Ghanaian currency in 2025.
Absolutely. But aren't you worried about some of the fiscal risks from this sort of move?
So there are fiscal risks, and it's not just me worried, it's also the politicians in Ghana that are worried. The people who are paying attention are also worried, because it's going to, if that could happen to them last year, where we saw gold prices actually surge the way it surged, the gold is not a commodity that just stays in a particular bandwidth. It goes up and down. It also moves like oil, daily price movement. So there's a fiscal risk associated, and I'm sure that the people in Ghana have sort of accounted that, but I'm sure they don't want to take that risk with their central bank anymore.
Okay, fantastic. Thanks for sharing your views. Unfortunately, we've run out of time. Great to have you with us, David Olujinmi of SBM Intelligence.